The report focuses on SMEs. Some people would say, all companies have been very stressed and challenged after the credit crisis. Why a specific focus on small and medium enterprises?
Generally, your SMEs produce about 95% of the jobs in any economy. And they are the people who are most subjected to the laws and the regulations of their own country. The larger companies buy an auditor or buy an accountant or buy a banker to take them through the process. So it's your SMEs which actually feel the impact of an economy.
What factors have you considered? We've heard of a few now from that brief insight provided in London there. There is a sense that there are limitations in this report. It doesn't evaluate the macroeconomic conditions in which a business operates, the infrastructure challenges that it may need to overcome, skills deficits, for instance. So exactly what is it you looked at?
Yes, it's very specific. What we look at is the legal and regulatory environment for business. We don't look at infrastructure, important as it is. We don't look at education. We don't look at market size. We just look at the laws and regulations which a government puts in place for its own business people. Why? Because it's a leading indicator. You can imagine if governments are trying to make life better for their businesses on something which is comparatively easy, like changing laws and regulations, they're doing the other stuff on the infrastructure and the other activities too. So it tends to be a leading indicator for something more fundamental, like the annual competitiveness index, which have about 200 different indices included.
All right, now in terms of implementing business regulation reforms, it seems as though the countries in Central Asia and Eastern Europe are doing really well. How does Africa fare?
Yes, those countries have traditionally been doing well. But Africa this time, I mean, we bring this out annually. This time we've got 3 countries in the top 10. Rwanda number 2. Cape Verde number 5 and Zambia number 7. These are the countries which have made the biggest change over the last year. The interesting thing about this report too is we've started producing, because we've now been going for 5 years looking at all 10 indicators, we started producing a 5-year cumulative improvement, which is much more useful than if someone gets a law through this year or next year. And on this measure, we've got 11 countries in sub-Saharan Africa in the top 30 in the world. So it clearly shows that African countries, certainly a large cadre of them, are reforming and reforming aggressively. Changing the world.
In terms of the indicator of starting a business, you've got, for instance, a country that's aroused a lot of investor interest, Angola. It's seen as the new frontier market for everything in post-war reconstruction and oil as well. But there we're told that on average to start a business, it takes you about a year. To close down a business takes you about 3 years. These are some of the challenges that persist in Africa. And despite how attractive Angola looks, that remains an impediment, for instance.
Yes, particularly to their local business. Angola, most countries with large natural resources, investors go there because they got the natural resources, in this case oil. And as you say, large construction projects funded through oil very often. But the local economy is not growing very well now.
Okay, and other countries, for instance, in terms of how they fare in Africa in terms of starting a business?
Well, I mean, as I say, our top 10, you sort of look at the countries like Rwanda, which has done stunningly over the last, it's the second highest reformer in the world over the last 10 years. Behind it, you've got Burkina Faso, Mali, Ghana, Mozambique, Nigeria, Sierra Leone, Senegal, Madagascar, Malawi or Mauritius. So you've got some really good reforming countries. I reckon there are about 18 countries in Africa, which is nearly half of sub-Saharan Africa, who really are on an active reforming path. And it's having impact. We've just seen a study recently by McKinsey, the large global international consultancy, who've looked at Africa. They did a report called Lions on the Move, which showed that across the area, those countries which were reforming were growing 3 times as fast as those which were not growing, which were not reforming.
It's the second time you mentioned Rwanda, and as you say, it's a consistent reformer and it's paying off, as it were. What is it that they're doing correctly? Because they seem to have applied quite a lot of recommendations.
They've made it their top priority. They're trying to change their history. They want you, when you think of Rwanda, to think of something different to 1994. They want you to think of a new world and a new environment. And they're aware that what led up to 1994 was indeed economic challenges. So they're led by their president. They've said building their economy is their number 1 priority. And they simply are, they've got a cabinet committee. He receives reports frequently on what's happening on different aspects of rebuilding the economy, and he's focused on it. Another one which has done very well is Mauritius, in the top 20 in the world.
Okay, Andrew, let's get your opinion on this one. Some of the criteria that are applied, for instance, is obviously business regulation. We've spoken about the level of transparency and efficiency in terms of the regulations, taxation, trade access, logistics, infrastructure in terms of logistics and getting goods to market, laws and things like bankruptcy procedures. When you hear that about 18 African countries have performed really well, that should excite you. But why is not sort of arousing a sense of deeper local investment in some of these economies?
Well, I think it's not as surprising as one might think, because you traditionally think of growth markets as Southeast Asia, you think of the Chinese type of story, but over the last decade, the area second to those groups is actually sub-Saharan Africa. So you've seen tremendous growth over there, and as we've mentioned before, growth numbers which are relatively high. Yeah. You've also got a large disparity between rich and poor, and there's that sort of transversing and getting into that gap of the lower class into middle class type of employment. So the small and medium sort of enterprises, there's been a lot of activity in that space.
I mean, we keep on saying that in Africa we need to engender a spirit of entrepreneurship. We need to nurture the growth of the local private sector. Private equity funds targeting Africa should be looking at these SMEs. But there seems to be some kind of a disconnect. The Africans are not investing in Africa. That's point number one. The FDI is looking at large-scale projects that often supersede the capacity of SMEs. Yet the SMEs are the big employers. The life cycle of SMEs tends to be short-lived because there's a point where they need to be sustainable financially, and the banks need to withdraw. So there are a lot of things counting against.
I think it's very, very difficult because in an African, and specifically a South African context, is the skills that are needed to get startup businesses to go beyond that into sustainable businesses is very often not there, and banks are hesitant to lend towards those. Compounding the sort of the compounding factor at the moment is the global financial crisis. The nature of that is that financial institutions aren't lending. In a South African context, you look towards your IDCs and players like that, which will start playing a massive role and have to play a massive role, so that we can get in the South African context. I think the SME sector makes up about 35% of the GDP and only 65% of employment, as opposed to the 80 or 90% that David mentioned globally. So that's a bridge that has to be crossed.
Okay, another issue that's been raised in this report, David, is trade facilitation reforms, and it seems to be the area where a lot of African governments have made a concerted effort to introduce changes. So they're making and introducing systems that will make it easier for goods to travel to market, and yet we keep on being told that intra-African trade, the figures are very, very low, and we need that in order to start growing at the levels at which Asia has done.
Yes, and we're just starting. Huge changes are being made largely around the customs and the trading and the trade transport routes themselves. But there's a lot of work in trade policy which needs to be worked on. There's a lot, and integrating economies. We've got an interesting project going up in East Africa with the EAC coming together. You've got the OHADA and IMUA in the ECOWAS region who are trying to build their economies together. So there are regional blocks trying to emerge, but there's a lot of work to be done. Right. I think one of the things, and this isn't politically very popular, one of the things we have to say is we almost have to disaggregate Africa. We used to talk of the Asian tigers, those countries which were moving fast ahead. We didn't throw Cambodia into that. And I'm afraid the same thing's happening in Africa. We've got about half of sub-Saharan Africa really doing the right things and moving ahead. The other half, still not quite there.
Okay.
And that's what makes it look not too good on average, whereas in reality, in about half of African countries, things are really moving.
Going forward, just to fast track the exercise of reforms, some things that really need improvement, according to the report, is legal systems. You know, investors want to see protection of their property rights. They also want to see improvement in bankruptcy procedures, for instance. They also want to see the introduction of collateral registries, because a lot of SMEs have movable assets, not just property. They want to see systems where credit information bureaus are set up. Why are all these things important?
Consistently, when you ask African businesses what their challenge is, their answer is it's access to finance. Why is their access to finance difficult? Because it's hard to register a company. It's hard to lend to an individual. It's much easier to lend to a company who's got a track record, has paid taxes for a couple of years. You can see what's happened. Secondly, you look for a collateral registry. You want to know that if you're giving someone a lease on his tractor, you're the only person giving him a lease on his tractor. You're not the fifth bank in a row when one day you need to foreclose. So it's that sort of basic financial infrastructure which makes it possible for banks then to lend so people get access to finance. So it really addresses the number one challenge, which is access to finance to grow.